probably would like to start off by asking from an investor point of view, what is factor investing and why does it exist?
Sure. So factor investing at its basic heart is really just foundational principles of investing. And you can go back effectively 90 years to Graham and Dodd's textbook on security valuations. And it was really based on the premise of buying high quality companies at reasonable valuations. And 90 years on from that, it's proven out that if you buy high quality companies on reasonable valuations, you generally do well and you outperform the market. And that's something that, same school as Warren Buffett, for example. And what we're doing when we think about factor investing is really the same principle. So we're looking for companies that are trading on relatively low valuations, high quality businesses that have some earnings growth and generally positive market sentiments towards them. And by focusing on those three drivers, what we find is that we generally outperform the market. And more importantly, the opposite of that, so these low quality, high valuation and poor sentiment types of companies generally underperform the market. But whether you're buying a milk bar or a mining company, the principles are really much the same. You want to buy high quality businesses that are growing and you don't want to pay too much for it. And that's really what we're thinking about when it comes to factor investing. So we use different words. So we'll focus on things like momentum, which is how much the company is growing. We'll look at things like quality in terms of what's the return on investment that the company is achieving, what's the amount of debt that they've got, and then we look ultimately at the valuation. So what's the price that we're paying for that growth and the quality of that business?
Sure.
But very similar to what most people would be looking at when they're looking to make an investment.
Yeah, for sure. I think that we have a similar view on what sort of factor is. I guess, factor is more, is a generalized word these days. There's a lot of meaning, a lot of different strengths of research that's attached to it. But I think, we're coming from a more multi-asset space, looking at, the first sort of definition for factors are macro factors. And they tend to be like inflation, interest rate, credit and growth that underpin the asset classes. And, multiple asset classes can have same or different factor drivers. Yep. So that's one definition of factor in our view. And the other sort of factor, probably more in line with Invesco, which we refer to as compensated factors or stylized factors. That really, the word compensated or price, typically refers to that. These factors historically have had positive risk returns or risk premiums and returns compensate for the risk that these factors carry over time.
Yeah, and I think that's a really good way to think about it, especially we use the word factor, but ultimately it's a common characteristic among stocks, and it could be anything. So a common characteristic could be effectively what industry a company resides in. Now, to your point, generally industry is not really a compensated factor, but we'd understand that valuations are a compensated factor, but it can really be anything, and that can be macro related. So sensitivity to interest rates, could be sensitivity to a particular sector orientation, or even geographical factors as well.
Yeah, I've seen some interesting sort of emerging research coming through, and really one of our view that why factor exists is because risk aversion. Yep. Generally investors in the markets are risk averse. Therefore, the happiness that they gain from earning $1 is always lower than the happiness loss of losing $1. So in other words, investors tend to prefer not to lose money than is to make money. And therefore, I think people prefer or stocks that are more correlated to the consumption cycle or business cycle tend to have lower demand. And the lower demand results in the price discount. And that price discount is the premium that investors get compensated for. So, value, size, or these companies are generally riskier. Yep. Therefore, for investors with patience and long horizon, tend to get compensated a longer term return. And I think, that's the beauty of factor investing is it's almost just like profiting from other people's behavioral biases.